this from a broader perspective and show you some stocks that are trending higher and a few that are going lower, and it's something we need to pay attention to. So right now the market is at a crossroad. Now, what do I mean by a crossroad? The market's kind of appraising at the speed at which these vaccines are coming out and when they'll be available, and at the same time taking into account the number of people getting sick and the fact that the COVID-19 is spiking again. So the market's kind of having, kind of figuring out where to go. And right now, as we speak, it's kind of favoring the broad economy reopening, but at the same time, it's still holding on to the stay-at-home stocks, which is creating a very, very interesting but a broader market cap. So right now, there's over 700 stocks making 90-day highs. That's very positive, and that's a very broad-based rally. And it's also telling us that the market is liking this transition between federal parties, between Trump and Biden. And again, I'm not trying to get political. I'm only reflecting on what the market is telling us right now. Now, with that said, I want to show you something very interesting. If you look at the financial sector, it is finally breaking out. This is very, very positive. It's the first time we've seen the financial sector break out since the dump that we saw in March of this year. And notice the sector's been really choppy, moving sideways for a long time, and now it's breaking out. But I want to remind you that we are still below the previous highs that the market was able to reach in January and February of last year, immediately pre the pandemic. And call me old-fashioned, call me cautious, call me crazy. You probably call me a lot of things. But my point here is I would be very, 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 very cautious on picking stocks, sectors, and industries that are trading below the January 2020 highs, simply because that's telling us that the sector has not brushed off all the garbage that's associated with it. So again, I would be very, very cautious right now. I would be cautiously optimistic because this looks like a really good breakout. But I'm going to tell you something. Even when it comes up here, you're still going to have plenty of time to get in on a pullback. So I like the financial sector. I like what it's doing right now. I like where it's going. But again, till I see the price above the 32 level, 31.50 level, I'm going to be very skeptical, all right? Now, here are some interesting developments. Uber stands to gain with the stay-at-home economy and without the stay-at-home economy. If the economy starts ticking up, more people are going to be using Uber. If the economy slows down, people will be using Uber for Uber Eats and so forth. But I think the biggest rally is happening right now because the markets are praising the fact that society is going to start opening up and moving again. So I wanted to show you two stocks, Uber and Starbucks, but we'll get into Starbucks in a minute. But Uber does a lot better when the markets are active and when the economy is expanding, because obviously people stay at home more. With COVID, people don't spend money, they don't go places, they don't go shopping, they don't go to the movies, they don't go out, they don't go visiting friends. So they still use Uber Eats, but again, there's a lot more activity when people are driving around the city doing whatever they're doing, traveling, whatever it is. But again, this suggests that the market is starting to assimilate a broader open economy, and it's going towards the direction of the vaccines. And that's not the only stock, Starbucks as well. People don't drink as much. People don't go and, you know what people, you've passed by Starbucks. You've seen what people do. They don't just pick up their coffee and go. There's a certain group of people that just sits there and drinks coffee with their computers all day. You haven't been seeing that lately because Starbucks have been closed. Only the outdoor locations have been open and so forth. But again, with the society closed, with everything being, with this fear of COVID, it has effectively put hundreds and thousands of Starbucks stores out of commission. And finally, we're starting to see a pickup. And notice again, it was very choppy. It was sideways for a good long time. And then about, right around August, things started getting a little better. And right now, since the election and with the vaccines being announced almost daily, we got 3 vaccines, we're starting to see more upside in Starbucks. And notice it's coincidentally moving along with Uber. Now, stocks that are not doing great. We got to talk about some stocks that are not doing great. And again, so far, crossroads, but again, I'm starting to see a little bit more excitement towards the freedom, getting out, stay at home, vaccines, getting back to normality. That seems to be winning out. But what's interesting, again, a lot of the stay-at-home stocks are also going up with it. It's a broad rally. As a matter of fact, I wanted to show you this. I wasn't planning to, but, I always do things I don't plan. That's how I operate, right? If you look here at the cumulative strength index, the S&P 500, and this is good. This is very positive. Look at this. Retail, copper, lithium, I don't know, retail, aerospace, shippers. Don't rule out shippers. But you see what I mean? General Motors, Harley Davidson, Discover Financial Services. I told you about that one too. Nordstrom's, General Electric, Royal Caribbean. It's broad. It's not just focused on the internet and biotech like it was 6 months ago. So this is very, very positive. Look at this. Alaska Airlines, Delta, Norwegian, Under Armour, United Rental. This is broad. Not totally broad, but fairly broad. In other words, if I was looking at this list and I didn't know about what happened the last 9 months, I would say, well, this looks normal. There's nothing really here that stands out too much. Maybe, if anything, it's the MGM Resorts, the Delta Airlines, the Norwegian. So I am liking this. I'm actually liking this, and I'm liking how broad it is. You got Basic Materials, you got General Electric, you got General Motors, Harley Davidson. I mean, this is Boeing's coming up, chemicals, a little bit of everything. That's how you know the stock market is getting healthier. And by the way, when a new president takes office, that's when the broader, the structural things happen. Because why? Well, the president starts talking about all the things he wants to achieve in the next 4 years. All the structural stuff, all the basic materials go with the structural. So again, it's a pickup. It's a strong magnet for a rally. And right now, with 700 stocks, let me show you this. I'm not kidding. I want to. Sometimes we have like 20, 30, 40. We've got, look at this, 702 stocks making 90-day highs and 30 stocks making 90-day lows. So now let's talk about the stocks that are on my chopping block. Ecpg, Encore Capital Group. Why? Well, they're an international company, finance company, providing debt recovery solutions and services for consumers. Folks, do you think consumers have money to pay back creditors right now? 3-year return, 22%. 1-year return, they're basically flat. I mean, they got an earnings per share growth versus previous quarter of negative 46%. Consumer loans, I'm not so sure about consumer loans. I know it's a Russell 2000 stocks, but right now, with the recovery that we're seeing, with the defaults, I'm not sure. I don't think consumer loans are going to get a lot of love. Now, with that said, the stock made an all-time high on September 2nd. It's been trading below the 200-day moving average. If this thing cracks below the 200-day moving average again, and the only reason it's rallying to the 50-day line is because financials are doing really well. But I'm going to tell you right now, it's not because of of consumer credit companies. Not even close. So keep your eye on this Encore. But let me show you this trend line here. It ain't looking all that pretty, all right? It really is not looking all that pretty. Look at that. So again, I would sell it right here, right below, right around the 34 level. And if it breaks above this trend line, I would dump it. But again, I'm not seeing this company get a lot of love. Not at all. Next one, Church and Dwight Corporation. Notice it's breaking also September 2nd high, couldn't go higher, hitting the 200-day moving average. If you look at what Church and Dwight do, they are consumer staples. They are the leading U.S. producer of sodium bicarbonate, popular known as baking soda. Well, I'm going to tell you something about soaps and cleaning. When Starbucks and Uber starts rallying, people are not concerned with soaps. This is what people are concerned with in the stay-at-home environment. Very specific, like Clorox. Remember, Clorox was rallying too. This is not a stock for this. This is a good stock for when things get really out of hand and people are panicking and they think they're dying from COVID. But now we know we've got vaccines. So who's going to be buying cleaning products? And remember, markets always discount everything that's known. I'm just not seeing a lot of, unless things really go crazy. But again, we already know that soaps, things like that, they're not that big of a deterrent. I mean, we know. I mean, if they were, then COVID rates wouldn't be spiking over the last several months and be at all-time highs right now. So again, when Starbucks and Uber are rallying, that means people are not as defensive. They want to go out. They're not thinking soaps. So Church and Dwight, I'm not sure about this stock. And here's another one, Grubhub. Also, looks like it peaked out around October. It's heading towards the 200-day line. I would wait for it to hit the 200-day line. But again, Grubhub is a delivery service. It's when people want to stay home and not go anywhere. When Uber is making all-time highs and Starbucks is beginning to rally hard, usually Grubhub doesn't do so well. This does well when people are scared. They want to eat at home. They don't want to be around people. Right now, look at this. You got cruise lines rallying. People want to be around other people. As a matter of fact, I want to show you something interesting. I was looking at this the other day, and this just goes hand in hand with what I was talking about. Expedia. Look at this on the NASDAQ 100, Expedia. People are booking trips. That's a travel agency, online travel agency. So when you look at Expedia and look at Marriott, I didn't even realize it. Marriott is number 4. So, and remember, stocks always price things ahead of time. So when you take that into account with these stocks like Royal Caribbean, like Delta Airlines, Alaska Airlines, MGM, Norwegian Cruise Lines. These stocks are not stay-at-home stocks. These are companies. These are consumer discretionary companies. These are cruise ships. The point is that these companies that have not been seeing love from Wall Street are now starting to move up. We're starting to see Marriott and Expedia as the top 2 NASDAQ stocks. We're starting to see consumer credit. We're starting to see soap. And we're starting to see delivery stocks, home delivery stocks, move south. It's telling us something. It's telling us that stocks are leaning a little bit more towards things moving back to normal, things recovery, people traveling, people having fun, people going out, people traveling, driving Uber, on Uber, using Uber, and going to Starbucks. Starbucks is a very social stock. Uber is a very social stock. Encore Capital, consumer credit, nah, not unless the Fed starts giving money, and they're tight right now. And remember, Republicans are still controlling the Senate. Soap, nah, people aren't thinking soap. People are thinking partying and having fun. Staying at home, delivering food at home, not right now. Again, this stock is still between the 50 and the 200-day moving average. Wait for Grubhub to trade below the 200-day moving average. CHD, wait for it to trade below the 200-day moving average. Encore Capital, buy it right below the 200-day moving average. So again, I'm starting to see the beginning of a change, especially with these social stocks rallying, with financials beginning to rally. But again, financials, be very, very cautious. Stick with financials like Morgan Stanley, and I'll show you why. Let me explain. Look at Morgan Stanley. They're an investment bank. They took out that high. See, that's that high. Look where they are. Let me show you Goldman Sachs. Look at Goldman Sachs. Investment bankers. Not all financials are killing it. See, Goldman still hasn't. Morgan Stanley has. So again, you want to be in stocks that are higher, even if in the financials, that have taken out. Make sure they have taken out the January. What day is this? Let's see here. January 17th high. the highest, make sure they're trading higher than they were January and February of this year. And I hope that helps and gives you some positioning and kind of gives you a good perspective of where to go, where not to go, where to stay away from, and where to be cautious. Take care, folks.